Hey, everybody. Welcome back to the Schwab Coaching Channel for our next topic, getting started with stock investing. Today, we're focusing on the when to buy conversation. I'm your host, Kevin Horner, and I am pleased to be here. Thank you all for joining today. See some familiar names there in the chat, as I often do. Hi to Eva, hey, Andrew, and Brown Buffalo. Some kind words. Always appreciate that. Thank you so much. Today we're going to focus in a bit on trend analysis, understanding trends, understanding a couple of the common basic indicators investors and traders might incorporate as they're giving thought to putting some money to work in maybe some of these stocks they're looking for. Previously, of course, we've discussed building watch lists of companies so that you have groups of stocks to refer back to, look at frequently. And a lot of the time, investors over the long haul might take an approach that says, when this thing is beginning to trend favorably, we would like to then expose dollars to an investment in that stock. And it's one of the ways that some investors think about things is investing utilizing longer run trends. So we're going to talk about trends considered long run, considered short run, and how investors and traders alike might consider and utilize those trends to their benefit for both investing and trading. So that's the plan for today. Take a minute and say hi to my friend Michael Fairborn there in the chat. He did a fantastic job last week in this class in my stead while I was away in enjoying some beach time there in Cancun. Thank you, Mike. But that class in particular was wonderful, highlighting conversation around dividend payers, dividend paying companies that are of the king and aristocrat variety. That is to say, those that are not only paying dividends, but increasing their dividends on annualized bases. So a wonderful review of opportunities. And if you're looking for more of that dividend conversation, I'd invite you to check that out. In fact, what I want to say is, I want to point out, I've got that link right here. I'm going to put that right into the session here in the chat so you all have it. So if you're interested in getting Mike's conversation around dividends specifically, check that one out. I thought it was a really great class, and in particular shared a couple of key special studies that are appropriate for dividends and monitoring dividends and just seeing how stocks react to price action if they happen to be key dividend payers. So a wonderful conversation there. Again, thanks to Mike for having that one. And I'd certainly encourage you, if you're looking for dividend chat, check that one out. All right, so let's get down to business today, everybody. Let me give you some reminders about our conversations here. Remember, the discussions we host are entirely informational and educational. Simply put, we do not make recommendations in this way, nor endorsements for approaches to trading the market. So please bear that in mind. We will be talking some semblance of technical analysis today, really just kind of foundational levels. But as it relates to technical analysis, one thing we encourage you to remember is to not base decisions exclusively off technical analysis. As I stated a little bit ago, some investors utilize a process that has them building a list of stocks they want to own, and that we do that through a fundamental level of review, balance sheet details. And then the technicals can be indicative and helpful as to when it might be appropriate to invest in those stocks. And so, again, that's just a two-piece review of things, and that's exactly what we want to give thought to. Multiple pieces to the puzzle. Consider as many pieces in making our decisions. All right, so today we are going to identify and define some technical indicators. Like I said, some very basic stuff as it relates to technical analysis. We'll discuss how the investors might utilize these levels and ideas as it relates to technical analysis to determine when they should be providing opportunities on the long side. That is to say, buying stocks potentially based on what they see in the trend. And then we're going to look at exactly what's going on in the S&P 500, because I find the S&P 500's long range and intermediate term charts to be wonderful examples of trend analysis that we can refer back to. It's the very broad index, 501 of the largest companies in the market, in the U.S. market, that is. So it gives us a really clearer picture of health of the overall top 500 at least. So that's what we'll be doing here today. So let's get started in discussion of the trend specifically, the technical trend of price action. So what is trend? What are we looking at when we see this in the form of the chart? Well, the chart itself, of course, is nothing more than the visual reflection of price action, right? Reflecting trades at price A and price B. Higher highs and higher lows is what we want to see along the way. And the easiest reflection of higher highs and higher lows might just be as simple as putting a view of the chart, and does the chart move from the lower left to the upper right, or does it perhaps move from the upper left to the lower right? Okay, very basic, right? But if we utilize that initially, well, we can see we would have, by definition, in this view, an uptrend on the screen here, okay? And we would define it a little deeper by looking for a series of price highs that continue to be higher than the last, while also showing us price lows that are higher than the last. So what we say a little more casually is we're looking for prices to reflect higher highs and higher lows. That is what gives us an uptrend. And in this particular view, you've got what some might refer to as a channel, right? Because it's pretty well defined as we look here in the, excuse me, as we take a peek. I'm going to utilize a bright yellow line, and let me see if I can just draw that channel in. It's going to look kind of like so, right? And that tells us that we've got that uptrend. And one key thing to know when you're looking at this uptrend is that as you see price retreat to the low line, right, the uptrend line, well, price tends to find a footing there. The selling eventually loses steam and settles out, and then we start to see prices moving back up, and we get a high, and then we get prices retreating. And this is the commonality of price action. Stocks move over time in these trends consistently, and it's our job, as in both investors and traders, to discern, is that the appropriate opportunity given my tolerance, my time frame, the amount that I'm willing to deploy in this trade? Is all of that pertinent and appropriate as it relates to recent price action and what I might be able to expect from prices moving forward? So when we're looking at this chart, one other thing to make note of is the very solid but smooth the line moving through the price action here. That is our simple moving average. And in this case, it is a 30-period simple moving average. So if this were, as we would expect commonly, a daily chart, then we would call that a 30-day simple moving average. And essentially, we calculate that. Now, thankfully, we don't have to calculate it. Our platforms do that for us. But the math on that is simple. You take the closing value over the last 30 trading sessions at each day along the way, and you then add them all up, divide by 30, and we have the average price as of that day. And that plot appears on the chart with a line, essentially. And because we are going forward in time, each new market day, that line connects, and it really just allows us to smooth out the price action. And so while I've drawn in this yellow band of channeled price action, a lot of traders are going to evaluate price action and dictate their willingness to be buying the market or selling the market in an individual indice, stock, etc., not because it broke below the line, but more importantly, because it was below the line, like here, and then here recaptured the line. And that's the delineating factor of what some traders and investors might say, well, we pulled back to a level of some terminology you might be familiar with, everybody, a level of potential support. And when the stock's price moves off of support, it is then believed that that is a successful test. And thereafter, bulls would tell you, bullish investors in the position, that the stock made a higher low after having made a higher high and has tested support appropriately. Now the belief is we can continue the new uptrend. And that's exactly what happened here after a brief pause right here. And then we were basically right back up. So that's what, at least as it relates to this uptrend, is what's been working out in this chart, right? Nice runs to the top of the channel, retreats either to the midpoint or in the case of the 30-day simple moving average, or perhaps down to the bottom of the channel, but ultimately holding the channel every step of the way. So again, higher highs, higher lows, key component to the uptrend, and potentially can utilize something as simple as a simple moving average to dictate when an investor or trader might wish to participate or join a given trend. Now, one of the keys that I think is a little tricky about this is being mindful of the fact that when these trends occur, they occur in all time frames. Meaning you look at it on a daily chart and you find that to be helpful because you happen to trade and pay attention on a day-to-day basis. That's perfect. But you can see the exact same stuff playing out over weekly charts and monthly charts or hourly charts or maybe 5-minute bar charts as well. The point is that the trend analysis can be done over any window of time and be pertinent. It just needs to be appropriate for the time frame in which you are choosing to invest. Okay, our next slide here is going to discuss what I just touched on very, very briefly, that being the breakdown of an understanding in support and resistance. So support and resistance, very basic, very common concepts as it relates to technical analysis and utilizing chart patterns for determining entry and exit points that traders might consider. But ultimately, support and resistance is a floor and a ceiling. So let me restate that a little more clearly. Support is commonly viewed as a floor for the price action, and the resistance is commonly viewed as a ceiling above us. So the yellow line that you see on this chart acted as both resistance at one point and support as another at another time. And that is a very, very key important note to make here, everybody. If this technical analysis discussion is new to you, what is so important is to understand that these common axioms that a trader will utter in the form of something as simple as what once was resistance can now be support. Well, there's a reason for it. And the reason is we've seen these play out in this way quite consistently. Now, never means that what is then considered to be support has to hold support, right? Price action will dictate what we need to be paying most attention to. But let's talk about that yellow line a little bit. Like I said, in here, we had instances where the yellow line was acting as resistance. And we even had an instance where we had tried to get above it, and the very next day we're back down below it, right? So we learned very quickly that we had met resistance and what an investor trader might say, failed at resistance until we got to here and we actually climbed higher. Okay, that's good to note, right? So we broke higher after breaking resistance. Remember, what is resistance? Resistance is our ceiling. And if we think about resistance as a ceiling, consider being in, as an example, my dining room as I am right now. And as I look up above me, I have the upper floor. And if by some chance I was to leap upward and jump into the ceiling, in theory, I might be able to punch through the ceiling above me. And in doing so, my hand would go through it and I would be in my upper level all of a sudden, right? Well, that's what price action has done here in this instance. It's popped through the ceiling. And now that it's through the ceiling, don't think of it as my fist going through the drywall, but rather think of it as price having had that ceiling lifted from above it altogether, right? So that ceiling is no longer there. And what happens when that ceiling is gone is we could start to see prices hold or maintain that former resistance, now potential support. We had a test right here, and we have a test right here. And then something interesting happened, didn't it, everybody? After we made this test, well, we started seeing a trend develop. And that's ultimately what we're always looking for as traders. Whether it's, if you're a bearish trader, you're looking for a downtrend, of course, lower highs and lower lows. But as a bullish trader, you're looking for the pattern we see developing here. Higher highs, higher lows, after having taken out an area previously thought to be resistance, now possible support, and then we start trending right after there. So, again, these are, I'm of the belief that you need to see these things, no matter how many times you see it on a chart like this or in a slide like this, a class like this, no matter how often you see it. Seeing this develop in the wild, as I like to say, in the charts, as you are watching price action move intraday over multiple days, multiple weeks, seeing that will really help solidify the learning of these concepts. And again, it's one thing to take it from the textbook studies, right? It's a whole other to see it live and then expect what you're seeing to play out because of what the technicals might suggest. And again, I want to make one key point about what I just said there as it relates to what the technicals might suggest. I often will utilize terms like that. Suggest, the price might do this, it could do this, it may do this. There's a lot of can, mays, and mights going on in our discussions as traders. The reason for that is that everything is about probabilities, not certainties. The market doesn't really provide us as many certainties as we would like. So because it's about probabilities, everything we do is essentially a lean one way or the other direction, not a, oh, this is absolutely going to happen, or this is absolutely not going to happen. Taking that approach, that's what I want to kind of discourage you from thinking about, right? Don't ever believe that what the opposite of what you think is going to happen can't occur, because it sure can. I can promise you that. So, support, our floor, resistance, our ceiling. If we break resistance, it then becomes support. And conversely, if we break support or our floor can now become our ceiling, right? So those are the key components to take away as it relates to support and resistance in looking for trends, right? And so as a reminder, while we talk about trends, yeah, we're always thinking we're looking for those uptrending positions. But in times where prices aren't trending, they commonly are moving sideways or what we call consolidations, allowing price to be digested. But our hope is that we trade out of those ranges and start trending thereafter. And the reason for that is that trends, once you see the trending scenario developing, it can be, for some investors and traders both, it can be a little more easy to understand rather than the action that just seems to be moving sideways in price, I think. So not all of us are the same in that way, though, of course. Some of us are going to be a bit more comfortable and confident in sideways markets, and there's nothing wrong with that. My encouragement is really to find the type of market that makes the most sense for the way that things make sense to you, essentially, and then work to trade those opportunities. There's so many opportunities in the marketplace. We don't have to struggle to find good ones. What we need to do is just be disciplined and work with the ones that make sense to us. I think that makes as much sense as anything else. If we start working too hard, because the market's not giving you what you're looking for, well, that's where I think we tend to make mistakes. So initially, if this is stuff that's new to you, getting started, A, keep it simple, try not to go too far, right? And B, work to locate opportunities that make sense to you, that you're comfy with. Try not to branch out until you've mastered one, maybe two concepts that work really, really well consistently. And I know that's hard because we all want to dive in feet first, or maybe head first, I guess, into the market and get working on things. But often it can be very beneficial to be patient, work your way through this process through the use of something like our paper money platform in Thinkorswim, for example. So, okay, let's talk about a couple of possible technical details that traders might incorporate here. There's definitely hundreds of technical indicators out there, but they all essentially are doing the same thing. They're evaluating price and volume every step of the way. Now, in the chart viewpoint that we are highlighting here, everything is going to be presented in what we call a pane or a window below the price action chart that we see. So we, of course, have our uptrending stock. We know it's uptrending because it's moving from the lower left to the upper right. We have a moving average through there. It's not defined in our screenshot here. Probably something in the neighborhood of a 50-day, could be the 30-day that we were looking at previously. But ultimately, we know we have an uptrend in place, and we know we are sitting in the neighborhood of what some traders, investors might call support, right? Because we're right on that uptrending moving average. Now, down below, we have the MACD histogram as one of our options, essentially giving you an indication of when prices have moved and oscillated to give indications potentially of prices moving back up after having a period of downtime, right? So, the MACD, for example, you can see where we made this excellent move to the upside. Here, we had this blow off top, I guess we could call it, because it was up there for just one day. But look at how the MACD was talking to us. It was all this indication of strength into that high. And then, as you can see, we started to lose our value and came back down and made that low price. And all of that happened to show us the MACD trading underneath the midpoint here, leaving us to pretty much an indication that we did not, as of yet, have any idea that we were ready to reassert our trend. And that's exactly what occurred right about here, right? When prices got above it. And then you can see all the while, when we made a low, well, the histogram started to shrink, right? All of these lines got smaller and smaller and smaller, giving us maybe a heads up. Maybe the selling is a little overdone, okay? And then we finally see price back up above our moving average, and now we get the green spikes once again, okay? So just some very basics, but again, what I want to remind us about as much as anything else is that there is such a thing as analysis paralysis, and often new traders, new investors alike, you learn about one, you learn about two, and you start to be drawn in. You start to believe that they're infallible, and that could not be further from the truth, of course. So because that's the case, I want to remind you that it's perfectly okay to learn a technical indicator or two, an oscillator or two that makes sense, but recognize it can also make just as much sense to fall back on basics. Is it an uptrend? Does it have higher highs and higher lows? What about support and resistance? Can it just be as simple as that? And the answer, of course, is yes. All right. And then the last thing we're going to talk briefly about here is volume. Volume, you'll notice here, position at the bottom of the chart. I got it here in all blue, but on our Thinkorswim platform, as you'll see when we navigate over there momentarily, you're going to see that my bars are color-coded to line up with the price action that I've got. So green bars are indicative of an up day in the stock price, and red indicative of a down day. And I apply those same color schemes to my chart, my volume bars, to reflect when I have an up or down day. And it can be helpful because the visual story is told by volume. What do we want to see from volume? Well, in an ideal world, if price is going higher, well, we want to see volume rising with it. We want enthusiasm with it. We want what a friend of mine often referred to it as. We want that rocket fuel to send prices higher. Okay. Now, that doesn't mean price can't go higher without the rocket fuel. Okay. It absolutely can still move up with light volume. That is not what I want to point out, but it can be considered confirmation. Okay. So that's what we're talking about, excuse me, specifically as it relates to prices. Prices can move regardless of volume profiles. So just bear that in mind. Would we be more comfortable if price was going higher and volume was moving upward with it, like we get in here? Yes. And that would be essentially confirmatory in nature, validating the price action you've seen. But it doesn't mean it has to go higher, of course. So please do keep that in mind as well. Excuse me. Thanks, everybody. Wanted to get wet that whistle a little bit. Now I can maybe make it a little easier to hear me and nobody has to listen to that horrible raspy voice of mine. Okay, so volume as it relates to price action, key component can be confirmatory. Don't allow light volume to dissuade necessarily. Allow price action to dictate. If you notice, well, I've got light volume in here, maybe I should be a little bit concerned. That's a note to make for yourself, but don't necessarily decide to just exit a trade because volume was light as the stock was moving higher. Follow price as much as you can, okay? And I'll show you what I'm talking about because we're going to look at the S&P 500 in just a second. And then as a screener scenario, we note here, have an idea of minimum volume requirements. When I often do screeners for you all in classes, everybody, we do try to do somewhere in the neighborhood of 500,000, but 250,000 is certainly for many traders sufficient volume on an average basis day to day for liquidity factors, the ability to buy a stock and sell a stock as you need to, right? So with that, let's take a look at the S&P 500 here. Let's go to some examples. I'm going to pull it up, and I've got the S&P 500 loaded here. Now, the unfortunate aspect is the S&P index doesn't give us volume, but what it does give us is the trend detail pretty clearly. So I'm going to bring a tool over here, and I just want to remove some of my moving averages. I've got the 20, the 50, and 200-day moving averages in here, and I am now going to just go directly to the 20-day, or pardon me, the 200-day only. So I'm basically just eliminating the rest. And that's because, well, it seems to be relatively significant here, huh? Let's back this out a little bit. Let's add 2 more years. And let's just look at how the 200-day moving average has been for the last 3 years. So as I stated a little bit ago, seeing these scenarios in the wild really helps to solidify a learning. And what did we say about resistance potentially acting and becoming support once broken? Well, we stated that that's exactly what can happen. So here we have, as an example, let me highlight this with my ovals. We broke below the 200-day moving average here in blue, and then we rallied into it, but we couldn't get above it. So that became an indication that the 200-day could continue to act as resistance for us moving forward. And it sure did, right? Because as we went forward, we got here and got into the 200-day moving average, took a little bit of a pause. Let's just zoom in on this, make this easy for us. Zoom in, we see we were right there, and then we pulled back. And then we were right there again, and we pulled back, okay? Not uncommon. But let's go deeper, okay? A little deeper. We had an uptrend working. We know it. This was brief uptrend, but it was an uptrend, right? Higher highs and higher lows. But we were running into our 200-day moving average, okay? Now, this is what I find to be interesting and probably a little tricky here, right? So we've got this Okay, higher highs in the short run, higher lows in the short run. And then take a look at the price action right here. The high this day was 4,100 on the nose, 4,151 cents. This day, the high, 4,196 cents. 50-cent difference, okay? Now, we pulled back immediately. So what do we take away from this? We had matching, not higher highs. Notably, if I extend my level to the left, check this out. This was our last high right here. These highs are lower than this, also lower than this one, right? So if I was going to try on a daily chart and parse this out, I could look at this and say, aha, I don't like the fact that we didn't break through it, that we only matched and then reversed. Further, I really didn't like the fact that we broke the uptrend line that was working. I need more time, right? And that trader would surely be afforded more time because eventually we did get above the 200-day moving average. And in so doing, we now have the opportunity for the 200-day moving average, formerly resistance, now to act as potential support. So let's go forward in time. Now, I know I showed you the full chart already, but it can be very helpful to go back one day at a time. All right, what am I thinking here? You know, did the stock hold the recent uptrend line? Here's a new uptrend line. Then, does this held every step of the way? Does it break down from there? Does it break down and test the 200-day for support? Let's find out. Aha! It did break down, but only to the 200-day, right? Right there. Let's go forward. Let's see. Oh, okay. So we got a bounce at the 200-day, right? We bounced a couple of days off of it. Could not move it any higher. And so we did come down and trade below the 200-day moving average. Now, this is where some of you might be feeling like, well, Kev, you say if I was below the 200-day moving average, I should be a little bit disciplined, right? Or a little bit cautious if I'm a long-range investor. That's absolutely right, because instances below the 200-day moving averages give you the belief that, hey, maybe the trend is in the process of breaking, right? And what is equally important is that we're talking about a long-run moving average. 200 sessions, everybody. That's 10 months on average, approximation, right? So 10 months in trend is pretty long. And I think a good way to be maybe thinking about, should I be deploying money or should I not? And at this point in the chart, it's still very unclear because we have a down sloping blue 200-day moving average, which tells us that for the last 200 days, ultimately price is still making lower highs. And so even though you might be feeling better in the shorter term and intermediate term, as we scale, if we were to scale back again, we might need to see the forest for the trees, right? To take that larger view up top as though we were the airplane. And that can be a little bit easier for us. So ultimately, the reminder is you got to consider the time frame with which you like to invest and trade. And for a lot of you who are not doing this day to day, even week to week, you got to give consideration to something like the 200-day moving average. And I definitely know many a trader who is only interested in stocks if they're over their 200-day moving average. Or further, they might say, you know what, if it's below the 200-day moving average, I'm utilizing that as a potential bearish play rather than bullish play. And that's fine as well, okay? But let's go forward. Let's go ahead and keep pushing here. So we've got prices improving. We finally made a higher high in here. I'm going to eliminate this here. And we went sideways. Remember, define your time frame. Every time frame you can find downtrend, uptrend. Here that we would call this little bit kind of a consolidation in here, right? Prices just moved between 4,050 and 4,200. And then as soon as it got through 4,200, and let's back it out. Remember why? What was going on back there at 42? Oh, well, a couple of things. One, it's a round figure, which oddly enough, market participants like to work with round figures as it relates to the S&P 500, at least. Certainly on these broad indices, the round figures carry some valuation or value or weight, I should say. So we had that consolidation. We started to trend, right? And if I put that, I'm going to take this 200-day moving average off real fast. So check this out. If I put this as a 20-day, I would bet that in this window right here, where we started to trend up, I think we probably trended utilizing the 20-day moving average, meaning I expect to see the orange line come through these lows in here, providing support. So let's see if I'm right. Okay. Notice here in this sideways window of time, how the 20-day moving average is right in between all the price action. Prices are above it and below it and above it and below it and below it. That's because we were rangy, meaning we weren't trending. But suddenly we got out of our consolidation, got outside of our range. And what happens? Now we are trending using that 20-day moving average. Okay. All right, let's go back, making it the 200-day. And let's go to where we are today. Ugh. So what are we thinking, everybody? We had that blue, wonderful 200-day moving average acting as support. And now we are below it. Now the reason I'm calling this out right here, let's just make note of this. Below the 200-day moving average, 1, 2, 3 days, 1, 2, 3, 4, right back up. 5 to 6 days. What is that? 6 in a row? 5 in a row? Green, beautiful days. No pause. I mean, we stopped on this one day at the 200-day. The next day, gapped higher, kept moving. Okay? That's pretty instructive for us when you consider how it worked here. We fell through the 200-day. Down 5 days in a row. All right. Now we're off of it. Okay, well, maybe we've got a new floor. Let's be optimistic. Potential new floor. Cool. Gap into the 200-day. Great. Unfortunately, we didn't hold. Now we're back below the gap level, right? So at the moment, what once was support could potentially be acting as resistance. Okay? So that's the big deal takeaway as it relates to something as simple as the S&P 500 here, right? Don't go too far in defining any level of support or resistance as having to absolutely hold one way or the other, okay? And further, remember that, and I think one thing that I haven't touched on here today is the point being around intraday price action versus closing price action having a bit more importance for us, meaning allow closing prices to be more indicative of your next view of the stock than anything else, right? Don't allow intraday moves necessarily, because that's what all these tails are. Some of us call them tails, some of us call them shadows, but essentially it's an indication. Like today, this was the S&P traded as low as 56.70 and then has now up to 57.0809. So we traded down, but we didn't, as of yet, I mean, we only got 20 minutes left. We didn't close down there, right? So that's a bounce. That could be a potential short-term, very short-term support. That remains to be seen. So I hope you all found this to be maybe a little bit instructive. You know, I recognize that technical analysis is anything but easy to get a grasp on initially. And further, I definitely know how hard it is to take concepts and strategies that you learn from a book or watching a class and then apply them to your own process. I know how difficult that is. I am a trader, just like all of you, okay? And an investor I take different approaches with different portions of my overall investable assets, but by nature, I'm a trader. And what I want you to know is it's a process, it's ongoing. It never ends. Don't look at it as there being a goal line somewhere to cross. It is something that rewards us over time by our consistency to our process and methodology. That's where we can improve individually and be better every step of the way. It really is incumbent on us to do that. I hope you all are open-minded to that idea. That is certainly a bit different than nuts and bolts details, but I believe that to be true. Spend your time honing those skills, recognize you're going to make mistakes, learn from those mistakes along the way, and try to limit those opportunities when given the chance. Brown Buffalo, let me see if I can answer your question. What are the parameters for making the candle and the wick? It's all tied to the price action for the day. So in a candlestick formation like this, it is, first of all, green because our last trade is above our open trade. I can see that right up at the top here, everybody. So by highlighting the current day, so it's currently trading at 57.10. Our open was 56.95. That's green. The low level of that wick down below is the low trade of the day at 56.70.94, and the wick at the top is our high trade of the day at 57.32. So thankfully, we don't have to make any alterations to those. That's going to be automatic. One thing some traders might do is change the candle structure in the sense that they want the candle to be green based on how it's trading versus yesterday's close rather than today's open. That's a personal preference, but default here is versus the open price. So all tied to price action intraday exclusively. And further, last note I'll give you, last little tidbit, I guess, as it relates to technical analysis, is that, when you see these tails like this, 3 in a row, almost all at the same level, that makes sense, right? I mean, you shouldn't make note of it. Turns out when we moved higher, that was a very important level of short-term support for us for that day. And when we fell through it, remember what was support? What was resistance can be support. It was supportive yesterday, very limited. It was supportive, or rather resistance today. Okay, we got through it, couldn't hold it. So from a very, very short window, that could easily be considered resistance as well. All right, everybody, I think we have covered quite a bit, but my hope is that we've maybe scratched the surface on understanding trends, support, resistance, and I want to invite and encourage you to come to some of the technical analysis stuff that's also available for you here right on the YouTube channel. But don't forget, you can visit us at least 4 days a week when I host the Trader Talk in Today's Market at Market Open on Mondays, Wednesdays, Thursdays, and Fridays. And during those sessions, it's all market analysis utilizing these concepts. So if you'd like to see that done in the wild, as I love to say, come visit for that. So thanks to my man, Michael Fairborn, there in the chat. Always appreciate Mike and everything that he does. Follow us on X, everybody, at Mike Fairborn CS, at Kevin Horner CS. Would appreciate that follow. And if you liked the discussion here today, don't forget to hit that thumbs up down below as well. Thanks for being here, everybody. Hope you have a great Thursday. I look forward to seeing you again soon.